In this episode, I'm going to be talking about cash flow, and in particular, why is cash flow so different from profit? And that's a massive confusing point for many people when they're just getting into their numbers side of their business. They always have this misconception of like, I'm making profit on the accounts, but when I look at the bank account, it doesn't line up. I don't have any cash there to show for it. Hello and welcome to the Profit and Cashflow Mastery podcast. I'm your host, Gavin Smith from the Profit Analyst, and in this podcast, I'm going to be showing you how simple, easy, and more important, how practical numbers can actually be for you as a small business owner. I have a pretty extensive finance career and background, but more importantly and more relevant to you is I'm a small business owner myself. I've built multiple businesses from startups and turnarounds through to 7 and even 8-figure plus businesses. And what I've learned along that journey is how to make numbers really simple and easy and practical and how to use them to guide you in your business strategies. And ultimately, that's what I now love doing. I love teaching other business owners how to make the numbers simple and easy so they can gain real clarity about their numbers. I love showing them how to identify what numbers actually matter in your business, but more importantly, I show you how to use your numbers so that you can make better decisions, which ultimately leads to better profitability, better cash flow, and growing and scaling businesses. So let's dive into it. There's kind of 3 main themes or points I want to touch on here about why cash flow is different from profitability and why we need to treat it in its own right, study it, analyze it, utilize those numbers in a way. And it's exactly why what I teach is called Profit and Cashflow Mastery, just to highlight the fact that they are 2 different areas and you need to focus on them. Let's talk about cash flow for a second. And just in its own right, there's 3 key concepts you need to understand around here about why it's different. The first one is that cash flow is different from profitability because of timing differences. And the simplest way to look at this is if you were to go and grab a P&L report, profitability report, out of your financial statements, out of Xero, or get it from your bookkeeper. If you were to go down with a little pencil next to each item that's listed on there and right next to it, when do you actually receive the cash or when do you actually pay it? And you can see how wildly different the timings are for different elements within your P&L. So for example, your sales, you might receive that cash on sale the day that it happens, or you might actually be sending an invoice to a client and you don't get paid for it for 7 days later, 30 days later, 30 days end of month for some people, even longer depending if you're dealing with bigger companies. And so when you're recording the sale and when you're receiving the cash can be wildly different. Next, you get down into your expense side of things. Costs of goods that you're buying, you might be paying for those cash in advance, or you might be buying them from suppliers who are giving you 30-day accounts or you 60-day accounts, and you're not actually paying those bills until much later. Next, we get to wages. And this one, we actually need to break it into different parts because you'll have your employees who you're paying them their wages and you're recording that wage expense in your P&L. But what's actually happening is you're only paying them the net pay. So you're paying them 80% of their weekly wage bills as cash, and you're paying that a week later or a fortnight later, whenever you're actually paying it. But then the component that you're withholding, their tax, their PAYG if you're in Australia, which you need to pay to the government, you're not actually paying that until up to 3 months later when you're doing your next BAS return. And so right the way down your P&L, you're going to be able to write different timing differences. Things you get paid in advance, things that occur at the day of the transactions, things where the cash happens later, some of them weeks in advance, months in advance, some of them weeks in arrears, months in arrears. And the point I'm making here is that the timing differences between your P&L and your cash flow are wildly different. And this is the main reason why people's bank accounts never match what it says within the profit. The other one which often catches people out is that there are transactions coming out of your bank account which are not what we call trading transactions, and therefore they do not appear on your P&L. So the P&L is a summary of your trading activities, the profitability of the business, but a transaction like repaying a loan balance is not a trading transaction. What's happening there is you're taking money out of your bank account, which is an asset on your balance sheet that you own. You're paying down a loan that you owe to a bank or somebody else, which is a liability on your balance sheet. So this is what we call a balance sheet transaction. You're just literally moving money from your bank account to pay down a loan. What's happening there is money's going out of your bank account, but it doesn't show up in the trading, in the P&L. But that money going out of your bank account does definitely show up in your cash flow as an outgoing cash outflow. And therefore, people often have these non-P&L transactions taking place in the background of their business, which when they look at the P&L and they see the profit, they're wondering why, again, profit isn't being sitting in my bank account. It's because you've got to take away from that profit things like loan repayments and stuff as well. And I've seen businesses before where people have built a big business utilizing finance. They're making great profits in the P&L. They're looking at their bank account and wondering why they don't have any cash there. And it's because they've built a business that's making great profits, but they don't realize how much they've utilized other people's money to build that business. And all that cash is going out the door to repay service loans along the way. Okay, so point 1, timing difference between P&L when it hits your cash flow. Point 2, why it's different is these non-P&L transactions, e.g. paying loans. The third point I want to point out here when it comes to cash flow is what drives your bank account is different cycles of payments that are at play within the bank account. And so it doesn't matter what business you're in, even if you're you're in the most steady business that's not impacted by seasonality and payment timings, your bank account, your bank balance is still a roller coaster ride. It's still full of ups and downs. I own a Pilates studio where the weekly cash inflow is almost the same every single week because all of our members are on a weekly direct debit. So it's super predictable what our cash inflow is going to be within that business. But when I look at that individual studio, over the space of 3 months, a quarter, its bank balance can range from $20,000 up to $100,000. And it's this wild roller coaster ride of where we are. And if you're a business owner who doesn't yet know how to read your financials, your P&L and your balance sheet, and you're just relying on the bank account as that indicator of how well is my business performing, that's an absolute emotional roller coaster ride connected to the bank balance. You think you're doing all right, you check in on the bank balance and there's no cash in there and you're questioning everything. Why am I even in this business? I'm terrible at business, bad idea. Next week you check in and the bank balance is really high and you're like, oh, I'm an entrepreneurial genius. Look at me go. I've absolutely mastered this. 1 week later, it's all cut away from you again. So we want to stop watching the bank balance and being on the bank balance emotional roller coaster ride. But what's driving this roller coaster? Let's talk about that for a second. What I want you to do, and I like people to just draw this out, it's the simplest way to imagine it. If you imagine we've got transactions coming out of your business bank account on a weekly basis. So just draw a little X, draw about 10 X's across a page, and that shows us transactions which are coming out of your bank weekly. Then on the next line down, we're going to say fortnightly transactions. And so every second one of the weekly line, we're going to draw another X here. So every second week, we've got a little X. This denotes transactions going out of the business on a fortnightly basis. Next row down, we're going to say monthly. So once every 4 weeks, we can draw a little X to show us transactions which are coming out of the business monthly. And then finally, we've got quarterly transactions. So things which draw, once every 8 weeks or 12 weeks, whatever you want to do here with the X. These are transactions coming out quarterly. And if you think about it, this is like bills which come out weekly are just the general operating expense of your business that you're paying all the time. Maybe putting fuel in the car or paying for ongoing bills. Fortnightly might be your wages. You're paying everybody on a fortnightly basis. Monthly, big chunkier things like rent or the superannuation payments or some kind of subscriptions that you're paying on a monthly basis. And then things that are quarterly, the great example of that is your BAS returns here in Australia, your tax returns that you have to pay once a quarter. Just the overlay of these different X's, if we draw a little line that kind of draws along where they line up with each other, we can see how much this is what's driving the ups and downs in your bank account balance. And it's just these different cycles of where they overlay, weekly, fortnightly, monthly, quarterly, is what's making the bank balance really high or really low. Weeks where you just have weekly transactions going out, bank balance is building up. Weeks where weekly, fortnightly, quarterly, monthly, everything lines up at once is when the bank balance comes crashing down. And those are the weeks that we hate as business owners. It's when you realize you've got the BAS due, the rent due, the super, the wages, everything coming in 1 week and your bank balance just goes disappearing. These happen. It happens to all of us here at least once a quarter when all these transactions line up. Doesn't mean your business is bad. It's just part of the ebbs and flows of your bank account balance. And again, we want to get away from being on that bank balance roller coaster ride, thinking that the bank balance is a real indicator of how the business is doing. These are the three things at play, which is why your bank balance is so different from your profitability and why we need to manage cash flow in its own right and put tools in place to master the cash flow. The final thing I will say about these cycles that are at play within your business, the beauty of that is it's actually quite easy to come along and do a little bit of analysis, understanding what the cycles are within your bank balance. And from here, we can actually project that forward. We can just keep those cycles going. And what this enables us to do is create a cash flow forecast for your business where we can already see what your bank balance is going to be every week, 12 weeks in advance. You can go as long as you want. I like to always have a 12-month, so 52-week weekly cash flow forecast mapped out for my business, which just constantly gets updated every week. This is one of the first tools we put in place for people because it's so empowering for you as a business owner to be not living on the bank balance roller coaster ride and actually have a weekly tool that shows you what your bank balance is going to be so that you can see where these low points are a long time in advance. And you know exactly what you need to have come in or go out within your business to make sure that you're safe from a cash perspective at any point in time. Gives you a real peace of mind. Lets you know, can I take 2 weeks off over Christmas? Can I afford to buy this short-term thing? Is it going to actually impact my cash position? So we're actually being able to utilize the cycles, these things which are impacting many business owners. We can actually utilize that same pattern to actually give us the power over our cash flow and what's going on. So there you have it. That's the key drivers of why cash flow is so different from profitability. There's timing differences between when you're paying for things or receiving money. There's non-P&L transactions hitting your bank account. And there's also just these natural different cycles at play, fortnightly, weekly, monthly things, which are what's driving your bank balance to be quite up and down. Thanks for tuning in to this episode of Profit and Cashflow Mastery. If this episode helped you gain clarity with your numbers, then please make sure you give us a 5-star review wherever you're listening to this. Don't forget to subscribe to our podcast. And if you want to stay connected, make sure you give us a follow on the socials at The Profit Analyst.